Let's talk about something most businesses deal with, some more quietly than others: unused inventory. It's sitting in warehouses, stock rooms, or distribution hubs. It's tying up cash, taking up space, and getting closer to expiration dates, versions of obsolete, or customer disinterests. The scary part: many businesses ignore it until it's too late. So, today we're going to talk about how to assess whether inventory is at risk, monetize or repurpose it strategically, and most importantly, build in a long term prevention strategy so that this doesn't keep happening. Let's break it down. Unused inventory isn't just annoying, it's really expensive. It ties up capital, so every unit sitting on a shelf represents money you've already spent, money you cannot reinvest in, let's say, marketing or new products or innovation. For example, Nike reported in 2022 that it had $9.7 billion in inventory, a 44% increase year over year. That increase contributed to the company's reduced gross margin due to markdowns and excessive storage costs. Storage costs, let's talk about that. The longer you hold on to inventory, the more you pay in warehousing, insurance, handling, and shrinkage. And if it's temperature controlled or needs special handling, those costs skyrocket. The risk of becoming obsolete. In industries like electronics or fashion, trends and technology evolve quickly. HP, or Hewlett Packard, once took a $5 billion write off for unsold inventory, in part because the product demand shifted faster than they anticipated. The costs go beyond cash. This inventory clogs up your systems, inflates your balance sheets, and impacts your agility. So, how do you know what's at risk? Ask yourself these four questions. Has it been in storage longer than the average sales cycle? Is demand dropping month over month? Are there newer models or versions on the market? And have you had to mark it down more than once? Let's look at a real world example. Best Buy, the electronics retailer, regularly marks down aging technology to move it before it becomes irrelevant. They use a combination of AI backed forecasting and manual overrides to flag SKUs that are aging out of relevance. This helped them avoid major overstock issues in a fast moving sector. If you've answered yes to any of those questions that I just mentioned, it's time to take action, because the longer you wait, the fewer options you're going to have. So let's walk through your options, starting with fast cash and fast moving towards strategic value recovery. Okay. The first one here is liquidate for immediate cash flow. If cash flow is tight, liquidation is the fastest way to recover some capital. Let's take Target, for example. In 2022, they proactively announced plans to cut $1.5 billion in inventory through an aggressive markdown and liquidation process to reset their inventory position after over ordering during supply chain disruptions. They took the hit early to avoid deeper losses later. You can use B2B liquidation marketplaces like Bstock or liquidation.com, secondary retailers or overstock partners, or even run a flash sale event. Just remember that this is about speed, not maximum profit. The second thing here is you can bundle with high demand products. If you've got a slow mover, bundle it with a fast mover to boost perceived value. Okay, let's take Sephora. They often use bundling in its retail strategy, especially during promotional events. Slower moving products are paired with best sellers in limited time bundles to clear excess inventory while maintaining brand value. You keep the price point high, deliver value to the customer, and avoid devaluing the item through deep discounts. Use as incentives or loyalty rewards. Turn extra inventory into a loyalty driver. Kohl's and Ulta Beauty have both used product incentives to drive loyalty signs up and spend thresholds. For example, spend 50, get a bonus gift, usually a product that's usually sitting in excess. It works because it drives conversion, adds perceived value, and still gets the product out the door. The fourth thing you can do here is donate for a tax write-off. Many organizations overlook the value of donation, but it can be financially smart and brand positive. Walmart donates millions of excess inventory through partners like Good 360, a nonprofit that distributes goods to vetted charities. These donations clear storage space, create goodwill, deliver tax deductions, depending on the jurisdiction and the donation type. Be sure to consult your tax advisor because there are real benefits here. And the fifth thing here is fix the root cause, forecasting and ordering. Finally, do not treat this as a one-time cleanup. The real win is preventing this problem in the first place. Take Zara, whose entire supply chain is built around fast, responsive inventory. By producing in smaller batches and reacting to demand in real time, they've created a model that keeps inventory lean and turnover fast. This involves better demand forecasting, revisiting supplier terms, setting reorder points based on real time trends, not assumptions. Inventory control is not just about finance, it's about operational health. Now, let's flip the script a little bit here. Here's how you turn this problem into a strategic asset. First, you want to use data-driven demand forecasting. You can leverage platforms like NetSuite and Infor or Microsoft Dynamics 360 to pull in real-time data from sales, seasonality, and supply chain changes. This reduces your guesswork. Unilever, I use them a lot, for example, uses AI-based forecasting to improve service levels and reduce inventory by dramatically adjusting based on regional demand patterns. Tap into secondary sales channels. Just because your primary sales market isn't biting doesn't mean no one else is. Dyson, a vacuum brand, sells refurbished and excess inventory through its own eBay store, retaining brand control while offloading excess units. You can explore platforms like eBay stores, Amazon outlet, B2B resale networks, pop-up events, and even leverage circular economy practices. If something can't be sold, can it be recycled or remanufactured? Patagonia, another great example, built its Worn Wear program to resell used and repaired goods, reducing waste and extending the product's life cycle. You don't have to go too far, but even repurposing parts, materials, or repackaging can reduce waste and costs. And yes, your ESG report will thank you. Here's the bottom line. Unused inventory doesn't have to be a loss. It's an opportunity in disguise. Whether you need to free up cash, win back storage space, or rebuild customer loyalty, there's a strategy that fits. But the real power comes from when you shift from reactive to proactive. So ask yourself, what's sitting on your shelves right now? What is it really costing you? And what are you going to do to stop it from happening again? You don't need to keep solving the same problem over and over. Use data, use strategy, use every tool available, and turn that pile of dead weight into a revenue opportunity that moves your business forward. If you found this helpful, subscribe for more insights on smart operations and sustainable growth, and drop a comment. What's your biggest challenge with excess inventory right now? Thanks for watching. I'll see you next time.